Welcome everyone to S3's Q1 2021 trading update. So the usual format for our trading update, I'll give a brief overview and then I'll quickly hand to Alex, who'll run us through the numbers. And then we'll do a quick review of the trends we're seeing in the market before we get to Q&A. Q1 for 2021, I think, look, a pleasing quarter where we're seeing, continued good sequential performance improvement, month over month, quarter over quarter, and that continued into the first quarter of 2021, the trend that we saw through the second half of 2020. And good momentum delivered by our focus and execution on our markets, and great to see growth in a number of our key regions, particularly our largest regions that Alex will highlight as we go through performance. I think it's a testament to the success of our strategy, but also the ability for S3 to continue to operate and execute regardless of the conditions around us. Because I think it's important to recognize, as we've laid out previously, that we're still in the ongoing management phase of this crisis. And until we fully solve what is at the core a global public health crisis, we won't be moving yet fully into recovery phase. As a result, we still believe, as we shared with you at our Q4 and full year trading update, that 2021 remains a very volatile situation that we'll still have to navigate through with our focus on execution and remaining really focused on our strategy and our delivery. And as a result, we won't be giving any guidance. But a great start to the year. And Alex, maybe over to you and we can go through the numbers.
Thank you very much, Mark. As Mark kind of said, a strong quarter one with performance ahead of management expectations. Group net fees down 1% on a constant currency basis. They were flat on adjusted for working days. There was one less working day, Q1 2021 than Q1 2020. And on a reported basis, actually up 1%. But I think the most important metric there is flat on a working day adjusted basis. And of course, versus Q1 2020, i.e. ahead of the impact of the pandemic. The contractor order book, we saw a significant sequential improvement there, up 1% at the end of the quarter. That compares to down 9% at the end of Q4 2020. The contractor order book being the value of contracts written up to the contractual end dates, assuming all hours are worked. And that was driven by continued and sequential improvements in sales activity, so kind of new deal generation, and improved contractor retention rates. So in the quarter, our contractor retention rates across the group were 2 percentage points higher at 90% this year compared to 88% last year. And just to give a bit of a flavour of the contractor order book by geography, just thinking of our 4 biggest contract geographies, DAC, contractor order book, up 6%, and that was up 2% at the end of 2020. US up 14%, that was down 1% at the end of Q4. Netherlands was down 1% at the end of Q1 versus down 17% at the end of Q4, so a significant shift there. And UK down 16% compared to down 20% at the end of Q4. So those are the kind of the biggest moving parts within that contractor order book, but very pleasing that we're now in a positive position there as we look into Q2. Strong performances, life sciences up 14% year on year. Life sciences represents 24% of group net fees, and tech up 1%, and that represents 48% of group net fees. And the top 5 countries representing now 85% of net fees, with Germany at 33% and the US at 24%. But overall, a pleasing quarter, down 1% compared to down 7% in Q4. So continued strong sequential progress. So moving on to regional performance and starting with DAC. So up 3% in the quarter, which is a strong performance, robust performance, and that's against Q1 2020, which was up 9%. So tough comps for the DAC region. And what we saw, and driven really principally in DAC by demand in life sciences, which was up 7%, driven by clinical research and development and quality assurance roles, and technology, which was up 14% in the DACH region year on year, driven by software development, cyber security, and data science skills. EMEA, excluding DACH, was down 14% in Q1. That compares to down 20% in Q4 2020. And really 70% of that region is the UK and the Netherlands. We've seen some good progress in the Netherlands, and call out here Dutch engineering. So that was up 16% year on year. That's about 40% of the Netherlands net fees. And in the UK, we've seen a sequential improvement, but there is an impact as we work through Q1 of IR35 and the impact that's having on client and candidate behaviours. And a lot of contracts are not getting extended at the moment beyond the end of March as people work through the new regulations. USA, a really strong performance, up 11% in Q4, up 19% in Q1 2021. Driven particularly strongly by life sciences and tech. So in life sciences, which was up 25% year on year, and which is about 38% of net fees. Clinical operations, driven by clinical operations and quality assurance, and in tech mobile applications continue to be in very high demand, tech up 43%. And then finally, in terms of the APAC region, so down 14% in Q1 compares to down 30% in Q4. We've seen some pleasing sequential performance from Singapore, but Japan, which is the largest country there, whilst it significant improvement in new deal generation towards the end of the quarter, particularly in tech and life sciences, that sets us up well for the second quarter. So in summary, a continued strong positioning. We have a strong balance sheet, net cash of 57 million at the end of the quarter. We have a fundamentally resilient contract business model. 75% of our net fees are from contract. We have a well-balanced business, both geographically and sectorally. The pie chart on the left-hand side there shows that 85% of our net fees come from our top 5 countries, our kind of core 5 countries. And we have a strong and unique focus on STEM, which you can see from the right-hand side there in terms of the skills that we place. Technology being 48% of net fees, life sciences 24%, engineering 20%, and banking, which is largely banking tech, 7%. So I'd like to now hand over to Mark.
Thank you, Alex. What I thought we'd do is, and now we've gone through the numbers, is give a view of what's driving those numbers, both in terms of what we're seeing in the market from trends, as well as a little bit about our strategy in action to give you a flavour of what actually drives that numbers, the resilient performance, and the ability for us to deliver long-term, sustainable, profitable growth. I think one of the things that we focused on as a result of working in the current conditions with the pandemic was to spend a significant amount of time, more than we probably have had before, with our clients in deeply understanding their changing needs moving forward. And as we shared previously, from that structured quantitative survey work, as well as qualitative interviews that we've done with our clients across the world, 3 broad trends emerged coming out of that remain true today. Focus on a more flexible and resilient workforce of the future, and questions around lessons to be learned from operating in the pandemic from all of our clients as to how companies think about their talent for the future and how they manage their workforce in a much more flexible and potentially semi-remote way for the future. Rebuilding global supply chains with a focus much more on resilience and sustainability, moving from that just in time to just in case, and a notion of building back better, particularly with sustainability and ESG at the top of mind. And lastly, and certainly not surprisingly, digital transformation acceleration and the acceleration of automation in all aspects of business, whether that be advanced robotics, data and data science, or digital connections with our customers, and both internal and external. But what we saw was different flavors as the year developed through 2020, and as we focused to the future in terms of how companies were responding inside those 3 trends. So not surprising, in Q2 last year, there was a real focus on crisis management in terms of focus on business continuity, supporting their people, understanding the logistical challenges and solving them, as well as rethinking what customer journeys were going to look like now people were operating in a very different environment. Once there was stabilization, there was then a shift towards, future growth and innovation, which all started with finding the right people, investigating alternative markets to find talent, and then planning for the future. And with that talent, thinking about how to create innovative solutions. And it was clear that there was a need for those specialist roles, particularly within life sciences, technology, and engineering, those skills becoming clearly more and more important as people were thinking about the future. And as we look forward in terms of Q4, Q1, and into the bulk of 21, it's much more around how do we navigate this new environment we find ourselves in. Our real focus on skills over sector, and so we'll talk a little bit about that in a minute. A broadened ecosystem of talent, and how does that work with both permanent and contingent labor to solve that flexible management of talent to deliver projects, and programs and projects being time-bound and the high impact nature of those, all driving a need for agility in thinking about the talent and skills that companies need to help them move forward. And what does that mean for S3? Well, it means that we're well positioned. As we shared before, we sit at the center of two long-term secular trends, and we're really seeing the acceleration of those trends come to the fore as a result of the impacts of the global pandemic. The demand for STEM talent continues to increase, and the nature of how people employ that talent on those time-bound high-impact programs, it has accelerated the need for agility for companies. At the intersection of that is investing to ensure resilience as people look to use those specialist key roles in a flexible way to deliver their future. Now, what I thought would be interesting to do is we think about technology and as one of our biggest segments, as Alex shared, is 48% of our net fees. Part of our strategy is not to look at technology generally, and part of the key value of S3 is really understanding not just STEM or life science, technology, and engineering specifically, but the niches that sit within that. And so here we took a snapshot of our US technology business to show some of the niches that fit within that and some of the demand patterns we saw through Q1 into Q1 2021. And what you can see here on this chart, that not all skills are created equally in terms of demand. And so you've got, whilst all demand is up generally in terms of technology, infrastructure delivery and software development is more muted than things like Adobe Experience Manager, which is an e-commerce suite, BI and data science, as well as mobile application development. And so there's real focus for us on deeply understanding the niches that sit inside life sciences, technology, and engineering, really drives our competitive differentiation, as well as understanding the environment in which to place that talent to have the biggest impact. So our focus is on niche specialization, nurturing the key candidates, those high quality specialists that can really make an impact day one when they go to meet our client. All of that combined has really driven that performance moving forward. So I think it's important to understand that we don't think of these things as macro trends. It's really deeply embedded in understanding the niches that sit inside those broad sectors that drives our performance. And so, but just before we take questions, in summing up, we've had a strong quarter in Q1 as we've navigated through a pretty extraordinary year in 2020. We do think there's going to be volatility moving forward, but S3 is certainly positioned strategically at the center of those two long-term secular trends, understanding the niches within that STEM talent, as well as how do we place that talent within a much more flexible working environment. And so we look forward, to 2021, and given the execution and our ability to execute through 2020, gives us confidence that whilst 2021 will continue to be volatile, we'll be able to navigate through that well. So with that, Tamsin, maybe we can open it up for questions.
we'll go to Sanjay Vidyarthi from Liberum.
Morning, Mark. Morning, Alex. Couple of questions for me. One is on productivity, which I think has improved very strongly in this quarter. Can we talk a little bit about how you expect that to evolve through the year, particularly any thoughts around headcount reinvestment during the year in particular markets where that might happen? Second question is, it looks like you've probably taken market share. And I know it's difficult to come by the data, but if you could talk a little bit about, you know, in the context of your longer term ambitions, how you think you've done in terms of market share. Thanks.
Great. Thank you, Sanjay. Why don't I have a crack at the second question and give you some view, and Alex can maybe fill in on the productivity question. So look, I think in all of our key markets, what we've seen is our performance has been from the data that we have locally ahead of the market. You know, a little bit like, you know, as you said, the data is hard to come by because you're always looking backwards on the market share, but we are confident that we continue to take market share in the core markets we're focused on. So in the US, UK, despite the negative performance, we're less negative than everyone else. In the Netherlands, certainly we can see from the ABU survey that we look at, we're ahead there. And in Germany, with some local data that we have, we continue to make good progress there. And moving up, you know, as the number 3 tech talent provider staffing company in Germany is a big move from where we were before in number 5. So we continue to move well on that ambition to take market share moving forward. On productivity, yes, you know, we've got, you know, headcount down and, you know, net fees at a different rate. So we do have, you know, productivity gains there. What I'd say is the productivity gains are over and above just that, you know, mathematical piece in terms of our ability to deliver our talent for our clients. And as we think about, you know, selective investment in our headcount moving forward in 21, we want to make sure that we hold on to as much of that productivity that we've gained moving forward, largely as a result of just learning to operate a little differently, and our clients learning to operate a little differently. The application of technology in certain aspects of the workflow that's been broadly adopted now. You know, things like video interviews, for example, on the client side, would be an example of how we're doing it, or accessing, you know, spending a lot of time with our candidate communities and how we access that. So I think there's a lot of that is built into that productivity, not just a kind of, you know, arithmetic view of net fees to, you know, number of heads. Alex, I don't know if you've got anything else specifically we want to talk about on productivity.
Well, I think I'd say just to build on that, it's not just arithmetic. The fact is that our new deal generation and retention rates are sequentially improving. With you know, as we can see from the statement, 17% lower average headcount in the quarter. So I think that's pleasing. It's not just cutting our way to greatness. It's growing that top line sequentially, which we've been doing really during the second half and into the first quarter. And I think in terms of the sequential investment, it will be very much focused on, you know, the US, Germany, and within those geographies, the niche skill areas, but not just limited to those. So there'll be attractive sectors in other of our core geographies too, but probably the principal focus there. But as Mark says, kind of holding on to as much of that productivity as possible, and therefore that profitability is profitable, whilst kind of judiciously and in a measured way, sequentially investing to make sure we've got the scale opportunities going forwards.
We'll go to Adrian Kearsey from Panmure Gordon.
Good morning, guys. Good Q1. The slide that you showed were the different niche skill sets within the US tech, I think was really interesting. To what extent can you look at, you know, sort of one territory and see similar trends in another territory? And then how's that then evolving your thinking in terms of where you could be investing headcount? And do those trends, I suppose one of the questions is, do those trends typically happen simultaneously across all territories, or do you find that you have different trends across different territories?
Thanks, Adrian. I think the rather unhelpful answer is going to be it depends. And so I think there's some trends that are relatively consistent globally. So if you think of BI, data science, or cybersecurity was the one that we saw in Germany, for example, that Alex highlighted. Those are broad trends that are you can see across many of our markets that we could do that, as well as ERP implementation. What's different in some instances when you get down to specific applications, so Salesforce versus SAP, or Adobe Experience Manager for e-commerce versus some other e-commerce platform, that's when it becomes very market specific, and we need to keep a handle on what's going on in that market. So part of the investment beyond headcount that we're focused on is on data and technology to give us those insights. And so, as we shared before, we've got this tool that we use in Germany called our market intelligence tool that really looks at some of the demand patterns, within the market to understand the differences in some of those niches. So there are some broad trends that are consistent that we can learn from one area and go to the other. There's others that are very specific to local market conditions that we need to stay close to our clients and our candidates.
And we'll go to Steve Wolf at Numis. Steve, go ahead and ask your question.
Morning. A couple from me. Just in terms of the engineering trends you're seeing, there seems to be a pickup in a couple of markets there. So if you could sort of talk about what type of roles and markets that were perhaps coming through. Any areas that you would point to country-wise where you think the day rates are starting to pick up as sort of an indication then of skills shortages already? And then thirdly, just as you think to invest in headcount, not particularly volumes and bodies necessarily to fulfill these sort of niche roles, where do you think the hardest area for you to recruit consultants into that then need the experience to create jobs and to bring in sort of candidates from that side, if that makes sense? That's a long-winded way of saying for your consultant skills shortages, as it were.
So why don't I take the last one first? And it's so part of our model of bringing consultants on is to get them to really understand the domain or space that they operate in as a core part of the training. So understanding the dynamics of the market, the skills that are in there, the candidate pools that are around there, and get to know who those candidates are, who are the best candidates to drive it. And that, domain expertise within those niches is part of that competitive advantage that we have moving forward. And that's always been, part of the skill that we've had moving forward. Staying close to those candidates, those, high quality specialist candidates, actually is our best indicator of what's going to happen moving forward as those skills begin to develop. And so, whilst candidates may have been, working on, one type of activity, in engineering, let's say, offshore project engineers that used to work in oil and gas, now they're working on renewable energy in terms of offshore substations for wind farms. And so that would be, following the candidate and understanding what's going on in the marketplace. And so that's always been our focus at Sthree with our consultants, and that's really part of our secret sauce, if you like, of understanding what's going on in the market, and that remains the focus today. Which is why it's not just about putting a numerical number of heads in, FTEs in. It's really doing that judiciously, not just across geographic market, but then within the specific niches within that market to match demand. And then Alex, I don't know if you've got you want to talk about which sectors we're seeing in engineering that are attractive. I know we got some of the Netherlands and other places that perform particularly well.
Yeah, so definitely the Netherlands being a strong performance, and also the US. So US, which is a significant part of that business, was also resilient. And I guess within there, a lot of that was around the power transmission and renewables within the US. But yes, it would be the US and the Netherlands that I think are probably particularly strong.
Yeah, and look, I think the broad trend, as Alex said, within that there are skills within, broader macro trends that you see. So reinvesting in power transmission infrastructure is where we're heavily exposed to in the US. And then I think we shared last quarter, the quarter before, our move from upstream E&P to renewables, largely solar and wind in the US. And you're seeing that come through in our strong performance there.
And Steve, you had a question around day rates more broadly, didn't you, in terms of contractor day rates? So look, we're seeing particular kind of strength, I guess, across IT, engineering, and life sciences globally. Just looking at the global picture, that's where we're seeing some increases based upon data from the first quarter. So it's early into the year, but those are the areas where we're seeing some attractive characteristics coming through in terms of those rates and the demand.
Perfect. That's great. Thank you both.
And that's the end of questions. Mark, do you have any closing remarks?
Thank you, everyone, for our Q1 trading update. Good to be matching Q1 2020, and in thinking about continuing our sequential performance improvements moving forward. I think it's pretty clear that we're positioned well within the trends that we're seeing moving forward, and when our ability to execute has really supported us. That combined with our business model that's got high level of recurring revenue type characteristics in terms of where the economics are. I think that sets us up well for long-term sustainable, profitable growth, which is what we're focused on. But with that, I will bid you good morning, and we'll look forward to seeing you when we do our next trading update for the 6 months ended 31st of May on the 14th of June. So see you all then, and have a good day. Thanks, everyone.
Cheers. Bye.